Forex Focus brought to you by IG, taking a look at the recent US dollar crash coming off of the inflation data that we got here in the US and huge moves we've seen across major Forex pairs, including the pound, the euro, the Australian dollar, to a lesser extent, Canadian dollar and yen. But USD lost more than actually 200 pips on the day against pound, lost around 180 pips against the euro, and lost around 150 pips against Australian dollar here today after CPI inflation reported less than expected. Dollar losing pennies across the board, across these three major currencies, and obviously also lost ground against others like the Swiss franc, Canadian dollar, and yen. But like I say, not as much as the historic day we saw against especially the pound and euro. This is actually the worst day of 2023 for the dollar against pound and euro. As you might expect, I mean, losing more than 2 pennies against that pound is huge. The market that coming into today was trading below 123 and now closing out today is trading close to, if not on top of 125. Crazy movement we're seeing here in the dollar depreciating. And you might say, well, what the heck, Frank? Inflation moving lower, isn't that the right direction? Don't we want that as a U.S. economy? Why is the dollar seeing such bearishness, such downside in tandem with this move? Well, we'll get to the effect of inflation on the dollar in just a second. We've got to connect a couple dots first. First being where inflation has been, where it is now, and where it could potentially be headed as CPI falls to 3.2%. One of the lowest levels that we've seen in the last year, 2 years almost, as CPI did hit 3% even for 1 month a couple of months ago. But either way, getting really close to the 2% target that the Federal Reserve aims for in the long run. And the most recent data point came in 0.1% lower than the expectation. So heading in the right direction at a faster pace than anticipated, with the idea being, okay, well, if we get to 2%, the target from the Federal Reserve, one, they should likely stop hiking interest rates, but two, they could even turn interest rates around and cut them. And that obviously could have an adverse effect on the US dollar relative to other major currencies. Just to give you all the information while we're here, core inflation also fell by more than expected here this month. But it is, if you've watched Fed Chair Powell recently, he uses the S word, sticky, worried about sticky inflation, and core inflation has been a little bit stickier than headline inflation, obviously up at 4% still relative to 3.2%, but still lowest reading since the later part of 2021. So for the last year here, and getting closer and closer to that 2% target. And you can see as well, looking at this data, you know, in the 2018, 2019, even 2020 range around the pandemic, inflation sitting around 2%. That's where the central bank wants it. And they will shift around interest rates to the downside if inflation is lower than 2%, the economy's too slow, or they'll shift interest rates higher to the upside if inflation is too high and the economy is moving too fast, goods and services getting too expensive for everyday people, and all the effects that go along with higher inflation that we've seen over the course of the last couple of years. Now, this most directly affects, like I say, what the Fed will do with short-term interest rates. They control the overnight interest rate, but that also pretty directly affects and influences yields across the U.S. Treasury curve. And we saw here across the U.S. yield curve, rates witnessed their highs on higher inflation over the course of the last couple of years. And now recently, as numbers have been headed, like I say, in the right direction, yields and all the corresponding rates and everything in that sector starting to back off those highs a little bit. And with that, we're seeing some dollar downside, as you might imagine, on the climb higher in U.S. rates over the course of the last couple of years to, multi-year highs. In tandem with that, you saw dollar strength. Now, why does this happen? As a quick aside, well, when a currency is witnessing a higher interest rate, the U.S. has higher interest rates than, let's say, Japan, then that can drum up more demand for those U.S. dollars to get that higher interest rate at the expense of a currency whose economy is witnessing a lower interest rate. And so as rates climbed here in the U.S. to levels not seen since 2007, U.S. dollar appreciated against major currencies like the yen to historic levels as well. And the particular example of dollar yen over the course of the last year or so, a couple of times hit historical highs that haven't been witnessed since the early 90s. And so this is all to say huge movement that we've seen because of inflation spiking higher, moving interest rates, and moving forex markets as well. But now, on the flip side of that relative strength is potential relative weakness. U.S. rates rose faster and higher than most major economies, and they're still higher than the UK, Canada, Euro area, Australia, Switzerland, and obviously Japan, who's been still negative this whole time. But if inflation does continue to head in that right direction and heads there faster than anticipated, then U.S. rates might also back off a little faster than anticipated, and that dollar could continue to pull back. That's a crash that we've been seeing here in the most recent 24 hours of trading, can obviously get even crazier if interest rates continue to move lower. What is the current expectation for rates moving lower? What's the market pricing in? And then what would the market have to see for dollar to continue its crash? And what would it have to see to bounce back? Well, right now, the market is pricing in about a 67% chance of the Fed cutting rates by 100 basis points or more in the next year. So right now we sit at 5.5%. And you can see here the peak of projections from futures traders trading in the Fed funds futures market from the CME group. The greatest probability is in that 4.5% range, essentially 100 basis points lower than where we currently are. But there also is some, large probabilities, 23% chance of getting down to 4 to 4.25%, and also around a 10% chance that the market sees that the Fed cuts all the way below 4% by the end of 2024. On the flip side, there is, a 10% chance that they only cut by 25 to 50 basis points. But you can see there in the next year's worth of Fed meetings, the market perceiving today that there's only a 0.3% chance that the Fed does not cut at all over the course of the next year. And so now you have to view this as, okay, the U.S. dollar market sees all of this, right? These markets all move in tandem. They are efficient like that. There's no, the futures market over here sees all of this, but the spot forex market doesn't see it. And so what could lead to a further US dollar crash would be more interest rate cuts being priced in, and essentially looking at these likelihoods from the CME group a week from now, a month from now, whenever, and the bulk of the probabilistic curve here being centered around 3.5%. You might expect US dollar, all things equal, US dollar to depreciate further against the pound, euro, and everybody else. On the flip side, these markets do shift very quickly. And we've seen that in the other direction as recently as a month ago. You'll remember in mid-October, interest rate markets in the U.S. were making new highs. The 10-year got to almost 5% for the first time since 06, 07 range. And so this can shift back the other way. And so if this curve gets back into focus around where rates currently are, around 5 to 5.5%, and they start to price out interest rate cuts from the Fed in 2024, then that US dollar could regain some of the strength that's been lost recently. So a lot of different options on the table. As you see, we're up at 5.5%, and so many possibilities from here, a lot of them looking like how much will the Fed cut, but this can shift very quickly in the other direction, which all else equal could be bullish for that US dollar. Obviously hasn't been bullish over the course of the last couple of hours of trading, as euro did bounce back from around 107 to now trading near 109. It's a crazy rally here in euro. And as we've seen, not only the last couple of years, going back to 2020, the high for euro USD is around 120, but you go back the last decade or so, and this is a market that can get back to 130, 140 if it gets back to those historically high levels that we saw prior to 2020. On the flip side, if inflation numbers pick back up, head closer to 5%, 6%, where they were last year, then you could see interest rates move even higher in the U.S. and get back down to where this market was last year for a little bit, parity or even below parity. But yeah, a lot of room for the dollar to fall further against this euro, but also against this pound that has in recent years been as high as 140. And still trading around $1.25 leaves, you can do the math, about 15 cents or 1,500 pips worth of action just to get back to those recent highs for pound and lows for dollar. And then, of course, you break that open. Any currency historians out there know that pound has been at 2 to 1 before, has been, in the 150 to 175 range for a lot of recent history in this pair. And so a lot of room to potentially fall for this dollar, not to mention if inflation falls and the gap between a Japanese interest rate and a U.S. interest rate, which is now, more than 5% worth of gap, it comes into 4% or 3% or even more if inflation falls into potentially deflationary territory over the course of the next year. Dollar is still within a couple hundred pips of 30-year highs against the yen. And so a lot of room to potentially fall there, with the caveat being these data points will continue to roll out. They are quite volatile, as we've seen here today. Some of the biggest days of the year to the downside for US dollar in a number of pairs. And so if that data heads in the other direction, dollar can appreciate once again. But right now, dollar's in crash mode. A lot of traders wondering how bad it can get.